right. Welcome to another episode, number 52 of the More Doors podcast. We're excited for today's guest. We are going to come with episode 50. You can see I'm not used to doing the intro.
Wow.
Episode 52 is going to come at you right after this. All right. Welcome back. Episode 52 of the More Doors podcast. Today, we have a phenomenal guest, the founder of Coastline Real Estate Advisors, Mr. Eric Friedman. So we're excited to have him on to share his wealth of knowledge and experience. But first, as always, we need to thank the people that make this happen. So check out our sponsors over at Deep Blue Capital. Check out deepbluere.com. Go over there and create your investor profile. Sign up for our newsletter. Check out all the new opportunities we have coming down our pipeline right now. And then head on over to Tore Studios, TORE studios.com for all your podcast and content creation and multimedia needs. Jesse will hook you up over there. Let's dive in today. I'm excited for this one. We're going to have Mr. Eric Friedman on the show today, bringing his wealth of knowledge and experience. He's the founder of Coastline Real Estate Advisors out of California. Eric, brother, welcome to the show. Thank you so much for taking the time.
No, thank you guys. This is awesome.
Absolutely, man. And we've got, it almost looks like Matt's a guest today too. Matt just had surgery, so he has to do it from home.
That's absolutely right.
How are you recovering from your lobotomy?
Yeah, slow and steady. I feel like I got hit by a truck over the weekend, but moderately better now. Now I just feel like I got hit like a Volkswagen.
I appreciate it. That's what commitment looks like. He's still on the show, even remotely, even recovering.
That's it.
Love that, man. Well, Eric, thank you for taking the time, man. Like I said before, I never love to do people's intros for them. So we'd love to kind of hear who is Eric, a little bit of background on Coastline, and just share what we need to know before we dive in.
No, 100%. I want to thank you both for having me on the show today. I sometimes do take a long walk off a short pier, so cut me off if I start going too long. No, we started the business back in 2001. We were buying multifamily value add deals in Southern California. That's kind of been our mantra for the last 20 years. We have invested in other states as well, but we do call Southern California home. We can talk a little bit about why that's important to us during the talk. And then over the years, we have simply kind of created a family of businesses that assist each other. So it's not, you could argue vertically integrated is the term, but we really look at it as they run independently and they're not solely dependent on each other. So over the years, we've started property management, construction, materials. We've recently also have a credit facility that we launched in the last couple of years because we've seen the need for that. So we're really opportunists by trade. We're entrepreneurial. The culture in the office is truly an entrepreneurial culture, which I think has a lot to do with being in California, being part of what we've seen with the internet since the early 2000s. And then just excited to be talking to you guys today.
Absolutely, brother. Appreciate it. And we've got a whole bunch of stuff I really want to dive into. Matt Pachowski kind of mentioned this before. You're our first guest that has primarily focused for a long time in California in general, but specifically the Southern California area. And so going all the way back to 2001, that's been important for you guys. Couple of things on that. What attracted you to that market in the first place? Why has that been your bread and butter? And how has that changed over the last 23 years investing in multifamily in Southern California?
Well, I think a couple of things. One is it's where we live, right? So you invest in what you know, you invest in the locations you understand. And what we were, my partner, Steve Ludwig, who's still my partner today, and we have Jimmy Killian's also another partner of ours that's joined back in 2008. But when Steve and I started, we had a meeting with a family friend of mine who is very successful in the real estate world. And he said, guys, you can be city specific or you can be asset class specific, but you have to know where you are because it's all about location at the end of the day. And we made a decision at that point. The argument is you could be in Santa Monica and you can know every politician in Santa Monica and you could buy every asset class in Santa Monica, or you could be value add and you can buy every apartment building. So no matter what apartment building you walk into, no matter where in the country it is, you know exactly what's right, what's wrong, and what you can do to create value. But at the end of the day, it's tricky, right? Apartments, you need to be at these assets. You have managers, assistant managers that are handling money, moving things. You've got repairs happening. And unless you have on-site and supervisors that you can trust, you need to really be able to get to somewhere to and from in a day. And so the deals we've done that have been comfortable for us are deals that, we as owners, when people hire us as property managers, they call us if there's an issue. They don't call a regional supervisor. We take pride in what we do. So we want to be able to get to and from those assets within a day's time. So historically, we have been Southern California. I love hearing everyone's moving out of California. Everyone's moving to Texas. Everyone's moving to Arizona. What you find is that that's the story, but the reality is different. There are people moving. There are companies moving. But there's an analysis actually done where there's more inflow to California than outflow. But that doesn't create news or excitement for the nation or for the politics, so it doesn't get reported. And so rents are skyrocketing here. There's need for housing here. And if you know how to operate in a value-add world, given all of the rent control laws and the state laws, city laws, and everything in between, you can be very successful in California. And at the end, I make this joke, and Kirk Herbstreit, sorry, this is my jumping off of the pier. Kirk Herbstreit actually said it at the Rose Bowl this year. When it's 30 degrees in Ohio and Chicago or Illinois, Wisconsin, Michigan, and the Rose Bowl is on and it's 80 degrees and sunny, there are people moving to California. And there's a tremendous amount of Midwesterners here, and that's why. I remember, I think the story goes, Illinois and Chicago were playing the Rose Bowl, I think in 62 or 63, and my parents were in Chicago, and they looked out the window and they both looked at each other and they said, "What are we doing here?" so there is value in where do you want to be? You want to be where the weather's nice, where, and like I said, rents are skyrocketing right now.
Yeah. So Eric, you made a good point before about being specific on an area or being specific on an asset class. And when you look at your portfolio, is there a specific asset class that you have high concentrations in?
We're value add apartment guys by trade.
Okay.
We do industrial as well. We have we are entitling a number of covered plays right now that are all one of them's apartment with an extra piece of land. The others are industrial, but we are tried and true value add apartments guys. The world's changing right now with what we're dealing with in real estate, so we are looking at a lot of stabilized deals where people are having some issues. But if you're looking for a team that knows how to get in there, how to renovate, how to create a proper turnover, and how to increase values of buildings, this is what we do. It's in our blood.
So what would be kind of a cookie cutter value add project plan for Coastline look like? Flooring, paint, and aesthetics, or are you guys doing bigger and much more detailed projects?
It's all of that in between. We're doing it's everything from the common area to the unit interiors. We'll do and the deferred maintenance. We're really taking these buildings down to the studs, and then making them better, modernizing them. The brilliance of the renovation company side we have in our materials, and why other clients, the big called the equity residentials, the UDRs of the world, that now insist on using our materials, is we're able to do a condo quality renovation at an apartment price, because we are direct business to business on that side. So it's a true value add that we can create. And people that live in these neighborhoods, whether they're Redondo Beach, Torrance, Beverly Hills, Santa Monica, Culver City, wherever they might be, they're able to move into a condo quality unit where they were previously living in a building that had been owned by generations by the same family, and it was brown carpet and old appliances.
Mm-hmm.
That's excellent, man. And that type of vertical integration, independent businesses, I want to get to that. I want to dive deeper on that in a moment. You just mentioned something, though, that I want to sidebar for just a second. And you say you can jump off a pier. I can jump off a cliff. So I'll have to bring that back.
Challenge accepted.
You just mentioned with everything that we're sort of seeing in the multifamily space right now, that you're looking at more stabilized deals as well. What I feel like you may be inferring is you're looking at the opportunities as they present themselves. And for the longest time, opportunity kind of presented itself in the form of value add, right? We have an asset here that if we make X amount of improvements and capital expenditures, rents can go here, and that's where the improvement in rents and price is. What it sounds like you're referring to is there's a lot of stabilized deals out there that the opportunity is not necessarily value add, but to restructure the deal potentially because of financing issues or other sorts of things, market variables that have been thrown at the current operators that they have to exit. Now it's an opportunity for somebody else. Am I getting clarity on why those stabilized deals are a little bit more attractive to you than some value add deals right now?
100%. It comes down to pricing as well. I mean, here's the reality. In the last 5 years, and tremendously due to COVID as well, sponsors bought buildings. They put floating rate interest on those buildings to renovate those buildings. When COVID hit and you couldn't renovate buildings, you couldn't turn units over, the business plans got stalled. And the business plans got stalled for up to 2.5, 3 years, especially in California, where it was very much a protection of everyone being able to live where they live,
right?
Which is fine, and there's no issue there. But that caught these sponsors behind. So now these 3-5 year loans are coming due or coming for extension, and the NOI has not changed. They have not been able to value add these deals, and so now all of these sponsors are stuck because they either need to find a lender that will lend to them based on the non increased NOI, or they're just going to have to sell. Mm-hmm. And a lot of that also happened with builders and people finishing up spec homes, spec townhouses, and whatnot. So there's an opportunity that has been created, and at the end of the day, we're entrepreneurs, we're opportunists, and we see that there's going to be a tremendous amount of opportunity to assist these sponsors, to allow them to exit a situation where they're not happy with, and create value. Yeah. So it is sort of that, what is happening in the world in this time period, and how do we take advantage of that? Yeah. Or how do we just become a part of it?
Sure.
Yeah. Is there a conversation, Eric? It's like we could, 2 years ago or a year ago, however long ago, right? You could be looking at a value add deal at $200 a door that you were going to try and drive to $225 or $250 a door through your value add strategy. But now it's, if there's a stabilized deal that you can get without necessarily doing a lift or a heavy lift, why not pursue that type of opportunity?
Yeah, I mean, that's it, right? It's sort of what would you take to get the same level of return? Would you take the higher risk of having to renovate a whole building, or just be able to go, when you buy the building, your cost basis is so good that you've already made your money.
Yep.
So it is that constant back and forth in the office discussions we have as well, because we do like the value adds and understand that our renovation, our materials business, we are consciously less than 25% of that receivable to those businesses. So it's not a function where we need one to support the other. But it is, so we were able to look in a silo at each business and what's best for that business, what's best for those investors, and what's the best return. But obviously, if you don't have to, throw a hammer to get the same return, there's less risk involved.
Sure.
And so we're right now we're looking at those deals where historically we didn't. Just to be honest.
Love it.
And that dovetails nicely back into where we kind of just jumped off there. You strayed away from the word vertical integration before, which understandably so, now that you just mentioned that statistic. So for your materials business, you're only 25% of the receivable. So that means you have 75% front-facing business on your materials side. So you've built a community of independent businesses, which is a very impressive thing to do. You've taken the idea and concept of vertical integration and then turned it front-facing, something that we're actually doing on a much smaller level in our own world right now, and going through the trials and tribulations of what that looks like. So we have a little bit of experience with it now. Of all the independent businesses you've built, as you've grown through this strategy of multifamily value add opportunities, what has the journey been like to go, this is the first independent business that makes the most sense for us to bring in-house? And then what did it look like to transition that business from solely in-house as a vertical to now we're taking on primarily front-facing clients, and now it's a whole separate business we have to run like a separate business?
It's I'd like to say that we are we had designed it that way. The reality is, sorry, I'm banging, it's shaking the table. The reality is, we started the businesses not as a business. We started them as a value add to the ability for us to buy and renovate apartment buildings. And how can we produce the best return? How can we save costs and be efficient in what we're spending? And so we did it in-house. We actually didn't create these other entities until after we had proven to ourselves that they could function on their own. So for example, we had our property management company. And when we started doing our in-house construction, we didn't create a separate construction company and create the corporate governance and go through that until we had really run in-house construction for, I want to say, a year and said, hey, you know what, this can stand on its own. Because if it couldn't, you've done all this work and now you got to shut it down.
Sure.
Which is a bigger hassle and a bigger discussion internally than just, hey, we tried something and it didn't work. Right. So once we decided at those points that these businesses had a functionality, and it really just happened, I was talking to you guys earlier, it really just happened, I would say amicably. It wasn't strategy. It was, we did it ourselves to create a better return for our investors. Our other third-party property management clients saw the renovations we were doing and said, hey guys, can you do that for us? And other friends of ours in the industry said, hey guys, can you do that for us? And that was sort of eye-opening for us. And that's when we started saying, okay, we could build something here. That was just on construction. And at that point, we were just importing materials or flooring, excuse me.
Sure.
So we were just, and that was the big issue. In apartments, water is your nightmare. I equate water to the velociraptors in Jurassic Park. They find a way. Water finds a way to mess everything up. And flooring became the solution. Vinyl plank flooring became that solution. It was impervious to water, replaced carpet, replaced rolled vinyl, and really made it simpler, easier, and cheaper to have a quick turn if a tenant moved out, to be more efficient and less vacancy loss. As we then, so separately, just to kind of go down that path of the family of businesses, as we got more and more comfortable with importing our own flooring, we got introduced to other factories and other locations. And at this point now, so call it 8 years later, within those 8 years, we had brought in other people to run those businesses appropriately, because we're good at what we know, but we don't know what we don't know. Yeah. And we knew that we didn't know how to run a materials business. We had to bring in somebody appropriate that knew how to do that. And then we've grown. So now if you look around your apartment, your home, your bedroom, your living room, your den, everything in that we import. I mean, from LED lights to electrical outlets to USB-C outlets to flooring, moldings. I'm just looking around the room I'm in right now. Base moldings, cabinetry, poles, fixtures, all plumbing fixtures, shower walls, and even counters. We import it all. Because at the end of the day, that was the issue. I think being value add guys to begin with and seeing the struggle you have in renovation, where you have to call, back in the early 2000s, you'd have to call a guy to do the flooring. You'd have to call a guy to do the paint. You'd have to call a guy to do the cabinetry. You'd have to call a guy to do X, Y, Z. We are the one-stop shop. And a lot of, I'll say all of our clients appreciate that. We are the one-stop solution where all the materials are packaged in a pallet and delivered. And so everything you need is right there and accounted for. If we're doing the renovations, we oversee the entire renovation. So it really takes that stress away from the sponsor and the construction team at a property management company to know that there is one point of contact, there's one point of material acquisition, and it's business to business. So you're not paying for Home Depot stores, you're not paying for their marketing or their advertising. We're getting rid of all those costs. Yeah. So it really became a value add, but we could not have done that without really creating, and that's why I don't call it vertical integration. I call it family of businesses, because each business is run by different people that know that business.
Well, and that was going to be my next question you get to a point where you've brought it in house, realize it could be another business. There's a very emotionally mature decision to be able to recognize this is a viable business and we're not the ones to run it. So at what point and how far into the journey did you go, we need to bring on a managing partner? And what did that journey look like to bring somebody on and say, now turn this vertical into an independent business and go run with this?
When you see so let's go back to 2015, 16, where we're running renovation. We have these materials in-house. We're running it. It's functioning, but it's not growing. And you're seeing more and more calls coming in for more materials. And you're realizing very quickly that we don't have the bandwidth to hyper focus on it. And when I say hyper focus on it, I don't necessarily mean just selling. I mean, on the accounting side, on the warehouse side, there's a lot of intricacies that go into renovation and construction and materials. So I would say it took us, we knew we had to do it. We've never been about labels or titles. We've never been about, who's in charge and introductions. It's actually, we all kind of get a little uncomfortable when we have to introduce ourselves at a conference or event and give ourselves a title. Steve Ludwig and I started the business literally on his dining room table. Yeah. Just the two of us. When Jimmy joined us, there was 4 of us at the time. And it was never about who's in charge. It was always about what do we need to get done and who's going to get that done. It's very much, how athletes work on a team. It's everyone has their role and just get it done. And so we knew very quickly that we didn't, as cool as it might be to say, oh, I'm XYZ of a materials business, we knew that we couldn't grow that business. So what's the point? If you have a business that you can't grow, then who cares if you're running it? So it was there really wasn't an issue bringing in people to run it appropriately because we knew we had to do that. And so it was, you just sort of got to check your ego at the door. Like there's no reason to have it. We've always looked at real estate literally from day one. It's a big pie. We don't need the whole thing. No one needs, I was talking about it yesterday with a friend of mine. I guess if you guys follow European soccer, Vinny Jr., who plays for Real Madrid, just got offered, I guess, $325 million a year to go play in Saudi Arabia. He already makes like $50 million a year. So does that difference really matter to him? Is that just an ego play if he does go over there? And for us, it's never been about the ego. So we're very happy if the business succeeds. We're all good. Sorry, I'm rambling. I guess what I want to say is 100% of zero is zero. Yeah. So you want to bring in the people you like working with and the people that can do it appropriately.
And with the family of businesses, I mean, sounds like what we've been kind of growing.
We call it the homeward community of businesses. Here.
Yes. How many employees do you have between all family businesses?
Between all the businesses, we probably have a little bit north of 100 employees.
Wow.
And how many of that kind of blend do they all blend together, or is everyone a function of their own? Because I know that you don't like to say integrated, right? They're standalone. So is there any blended, from a scalability and cost share?
There is on the renovation and materials side. There's I oversee, if we had to give ourselves names and titles, I'm in charge of the money. So on the accounting side of renovation and materials, yes, there are people that split time between those two businesses. Property management, no. If you're on the property management team, that's what you do. The good news is when you have this is they all know each other. So it's not that they're don't know who anyone is, and when they show up on site, they don't know who the renovation team is or who's in charge of renovation. So the good news is there is constant communication between property management, renovation, materials, but the employees for property management are employees of property management. And to be fair, one of our partners treats that very seriously. So he does actually steps away from the renovation material side. He would in essence be considered a silent partner because he holds those teams accountable for their pricing, for their work, and definitely calls them out. So it's understood what needs to happen and how it needs to happen. At the end of the day, we're fiduciaries and we need to do what's best for our clients and our investors.
Yeah, it's interesting that you say that. It's one of the things that's showing up in our world right now with building these independent businesses is the flow of communication between two standalone entities is paramount, right? We have a property management company and a home construction and maintenance company that serves it, but as an independent business. And the back end financials are incredibly important when the people over here need to make sure the people over here are lining everything up. It's something we're building processes around and learning a lot around right now. And it's incredibly important. In that vein, though, I know one of the things that you guys do really well, it seems like at Coastline and all of the community of businesses is utilize technology, automation, integration very, very well. from a broad perspective, we can dive as deep as you want. How do you guys win in that regard? What do you feel like you do really, really well from the tech side that makes the communication and flow between these businesses work at a high level?
Oh, it's funny because we talk about apartments in we have this discussion actually constantly. Technology was never a big, I'm going to say this, multifamily and industrial and maybe office, but maybe not so much office, is the last industry that I believe is going to adapt technology. And that's because it's been run by generations. They've either owned the properties for generations or they got into real estate in, just called 1970s, 1980s, and now the children are running it. And they've always done it, pencil to paper, marking down rents, doing what they're doing. So technology has never been a key piece of real estate. And so I think we did, when we started up our property management company, we adapted to technology right away because we had not, we didn't inherit real estate. We didn't, we really, the buildings we bought were our first buildings we had bought, and we understood the importance of technology. Technology, what it gives you is low overhead. If you can take advantage of what technology can offer, you can then be more efficient, time-wise and communication-wise, but also cost-wise. And so I remember touring an apartment complex for a family friend of ours he's an older gentleman. His dad and his uncle had built these buildings, and we met with the manager and we said, well, how do you collect rent? And she pulled out a paper ledger. And I was like, this is interesting. And this was in 2005. And I said,
was it at least written in pen or pencil? You could just erase stuff?
No,
okay.
No, it was in pencil. And it goes back to those famous words. That's how we've always done it.
Yeah.
Right. So I think now with new generations with technology, I think technology is it'll take that over and those buildings will adapt to. But technology, if it's done right, is going to create more efficiency, better, quicker decisions. There's no real off-market deal anymore, right? Before computers, you had brokers, you knew people, you get a phone call, you get a deal, you get something done. But now when you get a call from a broker, there's an off-market deal. It's already listed on LoopNet. Yeah. It's already up on MLS. Wherever you look, it's there. And he's just kind of calling you to say, hey, are you interested? I'm going to let you know, before I hit go on the computer. And so there's really that opportunity for an off-market deal is now down to where it was, just call it days. Now it's down to seconds, right? If you can answer the call and react quickly enough. And we've had those opportunities. We get a call on a Friday afternoon, deal has to get done. Are you guys in? Yes. And it's done. But I think technology has sped up real estate, and real estate's not a liquid market, right? Private equity has made it liquid. They've created IRRs. They've created systems to underwrite to try to sell these deals. But at the end of the day, real estate's not a liquid asset. Right. And so it's really about buying right cost basis, running it right. And it's not a sprint. It's having these assets for 30, 40 years and making money there. So it's really about, at the end of the day, you can't eat an IRR, we like to say. It's great for private equity to report and they earn their waterfalls. But at the end of the day, doesn't mean if you have a 60% IRR in 1 year, that does not mean that you got anything north of maybe 1.2 on your money. Yeah. Because it's a year, but the private equity firms love that. So it's really that transition of the importance of cash flow from real estate versus those returns. And technology allows you to get to initiate that faster. And so we have partners overseas. They can log into our property's software systems and they can pull income statements when they want to, right? They don't need to wait for us to get that income statement when we get back in the office. So it all kind of flows together.
So Eric, question for you. Like when you think about, managing your own portfolio and then third-party property, assets that you third-party manage for other people, JVs that you guys are in, so on and so forth, like how do you manage to deliver the same customer experience to an asset that you manage versus that you own? And what's really the secret sauce to doing that?
You just have to know, you just have to do it. You have to, once again, I go back to being fiduciaries. If you're managing that asset is no more or no less important than any other asset you're managing. You have to really just be hyper focused and do what's best for the building. It's almost like imagining that it's not their money or your money, and your goal is to hit that business plan. And our property management company understands that. Our supervisors understand that, and we understand that. So we've never grown the management company on purpose. We've never grown the management company too big that we couldn't focus on buildings that way. So we've been small on purpose in order to give that attention to our clients and to ourselves, to our own buildings.
Okay. Thank you.
That makes perfect sense.
Another question I had for you is, we operate largely in Texas or wholly in Texas. And I've heard a lot of stories and seen a lot of headlines about what it's like to be a multifamily operator in California. And as a matter of fact, I can remember a conversation I had with a third-party fee manager a couple of years ago. I think you were up around San Jose or Santa Clara, where one day the city came out and said, rents have gone up so much, you can't bill back for utilities anymore. So how do you operate in such a dynamic market where there's a lot more regulation in a state like Texas? And how have you managed to use that to your advantage?
It's it's definitely every day is a new day. It's someone said, do you enjoy what you do? A couple of years ago, I think my son asked me, he goes, do you like what you do, Dad? And I said, yes. And he said, why? I said, because every day is a new fire. Every day is a new issue. And so it's exciting. You wake up, you don't know what you're going to be dealing with that day, especially, and the argument is, and the nation looks at it, as what's happening in California. I think you have to know the cities you're investing in. And that's one of those arguments of why we've always been in Southern California, is we know the cities that we're operating in. We know the rules, we know the players there. So we've sort of, I guess quietly, I said earlier, you could know the city and invest everything in that city or the asset class. What we've learned is sort of there's a meld there. You need to know the cities and the asset class. And so we've been very successful in knowing and understanding how to operate within the cities. It includes the city of LA, includes Sacramento, includes San Diego, includes the South Bay of Los Angeles and the Inland Empire. There are rules, there are changes, and there's stories. This is in California, this is moving, and this is changing, and this is. At the end of the day, that might be happening in a city, in San Jose. Things happening in San Jose are not going to affect me down here. Things happening down here will affect me down here. But how do we know how to operate and handle that? And we've been very successful in working with the cities and understanding. And like I said, if we decided to get into value add today, I don't think we'd be successful. It's too tricky. But we've grown with the city in the state over the last 20 years, so we know the processes. And we know where we can push and where we can't push. And we've adjusted cities and locations we bought in.
And that's a really great point that you make about having that intimacy with the areas in which you operate. You guys have expanded outside of Southern California now. And so a couple of things on that. How do you underwrite going into new markets? Where do you find opportunity and how do you recognize it? And then how much of the independent businesses are you taking with you into a new market? Like managing a property outside of Southern California with your property management independent business, what does it look like to take on a new asset in a new area?
We've always been a small company. This is actually it's a scary question. And I think about this a lot. It's a great question. But the reality is you need to trust your on-site staff. You need to be able to communicate with them. You need to be able to be there with them. If we have gone to Nevada, we've managed in Nevada, but we brought teams from LA that wanted to move there. So we had a staff in Nevada that knew our system, knew our operations, and we had worked with for 10, 15, 12 years that we trusted implicitly. We've had other, and so that's the rub is, can you trust your operations team? And if you were going to go to Texas, or if we were going to go to Florida or Georgia, which are something that we look at constantly. Steve and I went to school in Georgia, the school called Emory in Atlanta, and we know Georgia. We know the apartments there. We understand the market there. My wife is from Alabama. We've looked at a tremendous amount of stuff in Birmingham and Huntsville. I know, I'm very familiar with the neighborhoods of these towns now. We look at Nashville. We look at even in the Midwest. But these other sectors of the U.S. get affected differently. But if we were to go buy there, it's not so much initially finding the building, but part of that diligence is flying out there to interview management companies. We know we can't manage it ourselves. Coastline Real Estate Advisors is not named Midwest Real Estate Advisors for a reason. And so we would have to have a property management company there, or have an asset manager here that says, hey guys, I'd like to relocate, and who's on top of those deals. So it's really comes down to HR, it comes down to personnel, it comes down to just being able to track your buildings. Once again, it falls back to that idea. You want somebody geographically located that understands the business plan, that understands how to watch over the property management company. And we do that here in California. We are asset managers and property managers. So we're overseeing what they're doing on a day-to-day basis. And you just need to have that trust in the teams you're hiring and the people you're out there doing it, because you're just not geographically there. I mean, that makes it tricky.
Yeah. And it goes back again, you've mentioned this several times now, it goes back to being a fiduciary. And I really appreciate that response, because, there are plenty of syndicators out there that the verticals or the independent businesses, they are responsible to growing and growing more revenue for those businesses. And so while they are fiduciary to their clients, they're also trying to drive revenue to their ancillary businesses. And so even taking on new markets, they'll look at trying to find a way that they're going to manage that property, whether it's remotely or wherever it is across the country, because it also serves the other side of their business. And you guys are mature enough and professional enough to go, we can't provide the type of quality property management in Alabama that we can in Southern California, but we know how to ask the right questions in interview. So as fiduciaries, we're going to go find the best manager there. Yeah, no,
that's a great point. We know, like I said, we've bought over $1 billion of real estate in the last 20 years. We can walk into any apartment building and we know what's right, what's wrong, no matter where in the country it is, right? And that's not tricky. We're not doing nuclear, we're not building nuclear weapons here. We're collecting rents, we're paying mortgages, and we're keeping tenants happy. So it really is a person-to-person industry. But you have to know what you're doing and how to do it. And you have, and by the way, if you're going to see a steal of a deal in Tallahassee, Florida, odds are everyone in Tallahassee has already seen that deal. So why is it coming to my desk? Yeah. So it's also that conversation of this looks a little peculiar. And what we have done is with the markets changing, with different firms cutting staff, we do have people out there sort of bird dogging deals for us and looking at stuff. But the constant the conversation back isn't, oh, this deal looks great, let's do it. The first conversation is, how do we properly run that deal? And if we can't answer that, then we don't go after the deal. We've been through many cycles, not many cycles. We've been through 2 cycles. We know what we're into. We know what we want to avoid. And I guess we're at different points in our life, right? If we were back in 05, 06, 07, I'm flying to Georgia every week to look at deals. Yeah. I've got 3 kids at home. My partners have 3 kids. My other partner has 2 kids. We don't want to be on an airplane every week flying around, right? So what's the best for us so that we can be the most efficient?
100%, man. And that leads me kind of exactly where we were trying to take this is, you guys have accomplished a lot, and I've appreciated learning everything about your entire community of businesses. What does the future look like? You guys have been doing this for 23 years now, over $1 billion in purchases. You have standalone businesses that are profitable, and things like seem are banging on all cylinders. What does the future for Coastline REA look like?
It goes back to that question of fire.
Yeah.
And it's like in an interview, where do you see yourself in 5 years? I mean, I'll be honest with you, I don't know. And I think that's a really honest answer. And I think people have to be okay with that answer. It's the same reason we started these businesses. We didn't know we were going to be a materials business. We didn't know we were going to be in a construction business. Those opportunities came to us. So I think we're going to keep growing. We just closed on another deal with a group from overseas. They want to grow tremendously here in the United States. I think I want to be a place in the future where people call and they know when they call me, they're going to get an honest answer. They know that when they call Coastline, we're going to tell them the truth. We're not going to try to sell them on something.
Sure.
And if we stay, we've always said, if we're transparent, if we're honest, if we're forthright with our investors, our clients, new clients, the market. That's what's important. That's why we sleep. That's why I sleep really well at night. We're doing the right things. I don't know when interest rates will come back. I don't know if they're going to drop in September. I don't know if they're going to go back to 3% again. I do know, though, that this is a story from an older gentleman. It must have been 85 at the time. I was in a mentor-mentee group here in the early 2000s, and the market had just changed in 06, 07. So interest rates went from 0.15% to 5%. Cap rates had adjusted. The world was freaking out. We didn't know what to do. And we said to this gentleman, we said, are we ever going to get back to where we were? And he laughed at us. And he said, you know what's great about America? Short-term memory. He said, within 3 years, you're going to be buying 2 caps like it wasn't, like you never knew the difference. And it was legitimately almost 3 years, like to the day, 3 years later, that we went into contract on the 2 cap deal. And everyone in the office was like, this is a great deal. So I think that, real estate has cycles. It's right now, it's time to not get scared, buckle down, understand you'll work through some things, you'll clean up, there's opportunities there. But, I think there's a great opportunity to buy right now, or it's coming up. It's not there right now. I think that there's a great growth for our materials business. Our construction business is pretty much in Southern California, and that one is sort of just clips along, that does what it does. You can only grow that business as much as you have people available in the field to work. So, and then property management is going to take on assets that we buy. So I think the opportunities are there. I don't want to be an acquisitions guy and sell the dream and then live the nightmare. So I can't say, oh, we're going to buy $300 million in the next 2 years. But we're going to be active and we're going to make moves, and we have great opportunities we're working on. And so I think if the argument is, where do I see our companies in 5 years? I see them, happy. I see the employees happy. I see growth happening, and I see, stable sales and stable growth across the board. Yeah. That would be my hope.
So with you going through 2 market cycles already, that experience, and we're using this as a way to, you're our 85-year-old mentor right now.
Yes.
You look great for your age, by the way.
Yeah, you need it's that Southern California life.
It's the sun, baby. It's the sun.
Yeah, it's that vitamin D. What has changed from the investor relations and bringing new investor clients in, right? So, we're hearing a lot of people coming on and saying it's harder to raise capital. It's harder to bring in new money, and they're struggling with it when they've never experienced that before. You guys going through 2 cycles of this, what's been your kind of, experience, and then what have you adapted to it?
Yeah, I think 100%. It's we talk about it every day as well. It's definitely harder to find capital. The capital is there, I think, and just inside, kind of getting a peek behind the curtain. I think what you're seeing are at the private equity firms, you have asset managers that don't want to take a risk to buy something. So they would rather sit back. I mean, the argument is there's so much private equity money out there. They're going to buy up everything. But at the end of the day, it's got to be people that make those decisions in those investment committees. And going through the last downturn, I think what we saw was that a lot of these private equity firms, though they're marketing themselves as they want to invest, no one wants to be responsible for making that first investment.
Yeah.
Because if that goes bad, then it goes bad for them, not necessarily the business. So I think there's tremendous opportunity if you have the right capital to beat out these guys. Individual sponsors can work faster, quicker, easier than a large conglomerate can. I think the relationships are key. I mean, it comes down to trust. You have to build those relationships. This group from overseas that we're working with right now, I mean, I've been on calls with them for almost 2 years, 2.5 years of just who are we, getting to know us. And now they are not affected by interest rates because they're all cash buyers and they trust us as partners, right? So it's, kind of trust the jockey, not the horse. And so they have a plan and we're going to help them effectuate that plan. Raising money, that's the fear, right? That's the argument. If you have a fund, you have your money, you have a deal, you can invest. If you have to find money for every deal, then the race is on. And I think it depends who the investor is, right? If it's a mom and pop, market's down, interest rates are up, they're nervous. Their coffers go shut. If it's a family office that understands there's opportunities, if you get to that right person at the right time, then that coffer opens up. So it's definitely a constant dialing for numbers, as we used to say in our 20s, to see who right now wants to be active.
Who's in charge of that at y'all's company?
So it goes back to that flat organization idea. There's 4 of us that handle acquisitions. So all 4 of us are involved in those sort of conversations.
Yeah.
Day to day with equity and sponsors. And then each one of us is in essence overseeing one of the family of businesses as well on a day-to-day basis. But like I said, it's a non-ego driven, this is my deal, not your deal atmosphere. It's very much all hands on deck. So when a deal comes in, we're all calling our individual contacts, and our individual connections we have. And there's people are saying, yeah, great, give them a call. Yeah. There's no like, oh, we don't do, I started at Arthur Andersen before they shut down.
Yeah.
And it was a constant. I had to, as a young Grom there, I had to calculate out each partner's revenue they brought into the firm every quarter. I had to run a tremendous pivot table for each one of our partners of clients they brought in and revenue that those clients have produced. Like a law firm would do as well. Who's your client? You get credit for that client, even though you may not be charging that client. And we don't operate that way. It doesn't do anybody any good. It's all hands on deck, everyone for the team.
Yeah, it sounds like you take a very similar approach to kind of our philosophy, where everybody's got a distinct role day to day, but on top of that, everybody lead generates.
Yeah, 100%. Yeah.
And I think same way, I don't think we even earmark it in our CRM who brings in what. It's just, we just do, everybody's in charge of raising capital when the time is there.
Yeah, it's when it's time to raise capital, it's very much of everyone's positive. Everyone's, hey, I'm having trouble with my contacts. Hey, I'm not with mine. Hey, great. Let me know what you need.
Yeah.
And listen, we've never not bought a building because we couldn't raise the money. So there's not a fear that we're not going to be able to raise the right money for the deal. And that's the other conversation. Is it the right money for the deal? Right. And who are you working with on those deals? So that's also a big part of the conversation. We've been very lucky with our partners on all of our deals, that they're fantastic. And once again, you have to get along with their head of acquisitions, their asset managers, their junior asset managers, accountants. And so we've been very lucky in our diligence in the diligence period when we're talking with them, that everyone gets along. Yeah. Everyone knows. And listen, partners, we'll have fights, we'll have arguments. And guess what? 3 minutes later, we're high-fiving, because it's not a personal argument. It's a fight for what we believe, and we take a moment to realize what's best, and we take it from there.
I mean, 100%.
That doesn't happen with us.
Yeah.
Well, you guys seem much bigger than I am, so it might be more fun with you guys.
Brian's chair is all the way up.
Yeah, exactly. I'm 4 feet tall. No, it's a good. I mean, like we have a philosophy, right? If you're not fighting every once in a while, you don't care enough about the business. I mean, truly, it's just exactly. No. Yeah. I mean, and there have been so many great nuggets for everything that you dropped. Honestly, this is one of I haven't said this in a while. I don't think any of us have. If you're listening, go back and rewind this one, because you're going to get something out of it, over and over again. And we truly appreciate all the time, Eric, and we want to be respectful of it. So as we start to head for the exit and wrap up, I hate to put you on the spot, general advice. If you give one piece of advice to somebody who's trying to build either a family of businesses, an entrepreneur, an operator, aspiring, you've learned a lot in your 20-something year journey with $1 billion+ in purchases. What advice would you give to somebody trying to aspire to do bigger things than where they're at right now?
Am I allowed to use bad words on the spot yet?
Oh, it's a fucking crazy. We haven't done it way more yet.
I would tell anybody, don't bullshit. Don't sell somebody on something. The money you're talking to, the brokers you're talking to, they've all done it. They all know it. They know the pitch. They know the sales. I think the success we've had, and I go back to it before, is our transparency, is our honesty. It's, if there's an issue, we don't hide the issue. you coordinate it, and and especially in a downturn. Hey guys, here's what's happening. Here's how we should attack it, and you create that partnership. We're on calls constantly with our big equity partners, but they know that we're not out to hide anything.
Sure.
And to make something look better than it is, or worse than it, or it is better, and we're only talking about the success. We're not talking about the other issues, and we take it. I think the other thing, I was talking to my kids this morning about this, and if you don't know the answer, don't bullshit an answer.
Yeah.
Tell someone, hey, that's a great question. I don't know. Let me find out. I'll get back to you tomorrow. That will earn more respect with private equity groups, family offices, individuals, people that work for you, people that you work with, because you're thinking, and you don't know everything. Like I said, we don't know what we don't know.
Yeah.
Right. So I think those are the important things. I think a lot of it comes down to character and people you want to work with. I was told this by a mentor. It's a small sandbox. Even the country of real estate is a small sandbox.
Yeah.
Everyone knows each other. Everyone's interacted with each other. Everyone heard of somebody. Between just Steve, Jimmy, and myself, we can probably find a 6 degrees of separation to every company in this country over the years. And so I think it's just, it comes down to, just be who you are, and don't try to bullshit people that are smarter than you. You're not the smartest person in the room. Yeah.
Love that, man.
I mean, it's just the truth.
That's fantastic advice, brother. Truly. Man, Eric, again, thank you for the time and the advice, all the nuggets. Where can people find you? Where can they connect with you?
They can, I've tried to stay, I talk about technology. I've tried to stay off of all tech. I'm still on Facebook. So if you want to find me, it's Eric Friedman on Facebook. There's a picture of me trapped behind my washer and dryer, which the renovation company loves to show in the morning. They said, Eric, send us pictures of you doing renovations, because the guys need a good laugh every so often. So if you see Eric Friedman on Facebook and I'm under a cabinet behind a washer, that's me. We have our websites. I go to tesoroproducts.com for materials, turnaroundsolutions.com. For our construction, coastlinerea.com for our construction management. And if you want to email me, it's super simple. It's just ejf@coastlinerea.com.
Perfect, brother. Perfect. And we'll drop all the links in the show notes for anybody that wants to go check out all the different companies and connect with you. Absolutely, man. Boys, that was great. Fantastic, man. Again, Eric, thank you for the time. Make sure you go over and check out deepbluere.com as well. Check out coastlinerea.com. Make sure you go check out Tesoro Products as well. We'll drop all the links in the show notes. Eric, would love to continue to have you on every once in a while. I hear more about your journey in the future. So thank you so much for taking the time, being with us on episode 52. Another one of the books, boys.
Yeah, we want to get more guests just like Eric, so we need your help. All you got to do is go into our YouTube channel, go to More Doors, our More Doors podcast channel there in YouTube. You can search it, or it'll be in the show link. So hit that subscribe button, as well as Spotify or any podcast listening device you have. Leave us a review, please, because when we try to take Eric's time, we got to show him the reviews, because we got to show him that there's really listeners, and it's not just us three and then Jesse, producing it. So go leave us a review, 5 stars only. If it's not 5 stars, blame Brian. And then we'll see you on the next one.
Episode 52 in the books. Thank you, everybody. We'll see you next time.
Later, boys.